Here we have the answers to the exercises at the end of Unit 9, and in Exercise 1 we're going to be dealing with interest capitalization. What's happening here? Well, Michelson Motorsports is constructing a new production facility. This production facility is obviously going to cost a significant amount of funds, so they went and they borrowed $300,000 at 6% from Berkshire Bank, specifically for the purpose of constructing this building. And construction happened during the year. They had to make expenditures to fund this construction. What actual expenditures did they have? On January 1st, they spent $165,000. On February 28th, they spent $120,000. On September 1st, they spent $180,000. And on December 31st, they spent $35,000. In total, they spent $500,000 during the year constructing this new production facility. In addition to that loan they took out from Berkshire, which was for the specific purpose of constructing this asset, they have general debt like all companies do. They're signing notes, they're issuing bonds to bondholders. So what does Michelson have? They have a 5-year note in the face value of $400,000, which pays interest at a 4% rate. And they have issued 10-year bonds with a face value of $200,000 that pay interest at a 7% rate. Well, now we need to figure out a thing called our weighted average expenditures, which is a number that we're going to need to do calculations later on to figure out what amount of interest we paid during the period that was specific to the construction of this self-constructed asset, our new production facility. So we need to first figure out what our weighted average expenditures were for the period. The first expenditure happened on December 1st, and it was for $165,000. Well, we need to take into consideration the capitalization period. That is the time frame for which we can accrue this interest and capitalize it to the asset that we are constructing. And it goes from the time it was actually spent, this expenditure was made, until we finished construction. Well, it tells us that we finished construction on December 31st, which means if we made this expenditure on January 1st and we didn't finish construction until December 31st, the whole year counts. So our capitalization period is going to be 12 out of 12. And if we multiply our actual expenditure by that, we get $165,000 going to our weighted average expenditure. Next up, on February 28th, Michelson made another expenditure of $120,000. Again, they can only capitalize for the period after the expenditure was made until the job was done. So this is on February 28th, which means they can't use January or February because those months had already passed, so they get the rest of the year, March through December, or 10 months. So if they multiply that actual expenditure of $120,000 by 10/12, their weighted average expenditure is going to be $100,000. Repeat this process for the next two expenditures. On September 1st, actual expenditure was $180,000. They get to capitalize for September, October, November, and December. That's 4 months, which means that the weighted average expenditure was $60,000. And their last expenditure was on December 31st. This is a $35,000 expenditure for finalizing this building, apparently. But since this was the day that construction was completed, there is no capitalization period. Like this finished construction, there was no time that interest accrued after they made the expenditure. So our weighted average expenditure is 0. So while the actual expenditure was $500,000 on the construction of this facility, our weighted average expenditures for the purpose of capitalizing interest is going to be $325,000, and we'll bring that number back later. Next step we got to do is we have to figure out how much actual interest did this company incur during the period. They had that specific purpose loan from Berkshire, $300,000 at 6% interest, and they also had a notes payable and bonds payable on their books. That's their general debt. So how much interest in total between these three different things did Michelson accrue or have to pay during the year? Start with our specific debt, which is that specific purpose loan. It has a face value of $300,000. The interest rate was 6%. They took it out on January 1st, which means it accrued interest for the whole entire year. So by the end of the year, that would have been $18,000 in interest. For their general debt, they had the 5-year note, and we're going to assume it was on for the whole period as well. Face value of $400,000. had an interest rate of 4%, which means that's $16,000 in interest they paid on the note. And then for the 10-year bond, $200,000 was the face value. It's at 7% interest, which means they would have accrued $14,000 worth of interest on these bonds. And in total, they had $900,000 worth of debt on their books during the year, and their actual interest expenditure related to all of their debt is going to total up to be $48,000. So their actual interest paid during the period was $48,000. Now we need to calculate the weighted average interest rate of Michelson Motorsports general debt. And to do this, what you need to do is you need to sum up how much the principal is of the general debt and how much interest you paid on that general debt during the period. So the interest that we paid $16,000 on the 5-year note. We paid $14,000 on the 10-year bonds. We add those together. Michelson Motorsports paid $30,000 in interest just on their general debt. The specific purpose loan is specific debt, doesn't count for this because we're looking for the weighted average interest rate of general debt. What was the principal of their general debt? Well, it was $400,000 for the note, $200,000 for the bonds. That was $600,000. And if we divide our $30,000 in actual interest by the $600,000 of principal, the weighted average interest rate of our general debt is 5%. Now that we have our weighted average expenditures, and now that we know the weighted average interest rate of our general debt, we can figure out what they call the avoidable interest, the amount of interest we wouldn't have had to pay if we never constructed this building in the first place. And the first thing that you're going to have to identify is, in total, what were your weighted average expenditures. So for Michelson Motorsports, their weighted average expenditures was $325,000. They have two different types of debt. They have specific debt, that loan they took out just for this purpose, and they have general debt, all of the other debt that raises funds that they can do whatever they please with. Well, for that specific debt, it was $300,000 that they borrowed from Berkshire. If it's specifically for the reason of constructing this asset, I think it makes sense that we use all of the money that's earmarked in this loan for construction of that asset first before we even dip into our general debt. So let's take all $300,000 from that loan and put it into our accumulated expenditures. The interest rate on that loan was 6%, which means that the avoidable amount of interest that Michelson had was $18,000. If they never took this loan out to construct that asset, they would have never had to pay the $18,000 in interest. And now this is where we're going to need that $325,000, since our specific purpose loan doesn't have enough in it, I guess, to cover our weighted average expenditures. We have to take some money out of our general debt. How much? Well, we have $325,000 in weighted average expenditures. We have a $300,000 specific purpose loan, which means we need to take $25,000 out of our general debt. When we're figuring out avoidable interest, we assume that $25,000 comes at the weighted average interest rate of our general debt, which was 5%, which comes out to be $1,250 in interest. So now our accumulated expenditures add up to $325,000, exactly what we needed them to. And the amount of avoidable interest that we incurred was $19,250. So we would have never incurred that interest had we not built this facility. And that's important because GAAP law says that you have to, when self-constructing an asset or when capitalizing interest, you have to capitalize the lower of actual or avoidable. Well, Michelson's actual interest was $48,000. Their avoidable interest was $19,250, and since GAAP policy says that we have to capitalize the lower of these two, we're going to capitalize the avoidable interest of $19,250. And I will be honest with you, 99% of the time it's going to be your avoidable interest. There are cases where actual will be lower than avoidable, but they're edge cases. I'm pretty sure every question you're going to see in this class is going to have avoidable interest be the lower amount. So let's put this on the books to capitalize it. What are you going to do? When we are buying assets, they say we get to record necessary costs of everything in order to get that asset into, practical functional use. So if we buy a machine and we have to pay delivery expenses and we have to reinforce the foundation and maybe we have to rewire our facility to bring more power to this machine. All of those costs get capitalized in the cost of the machine when we put it on the books because they're necessary costs. But what we're saying here is you can't expect a company to have millions of dollars of cash sitting around at all times. So taking out loans to finance these assets is a necessary cost. It's a part of normal business. So we're going to put that interest, which is the lower of these two, the avoidable interest, we're going to put the cost right into what we record our building at, because it was a necessary cost of getting that building into functional, useful condition. And we're going to debit buildings for the interest of $19,250, and we're not going to record that interest as an expense, so we're going to take it right out of interest expense, $19,250. So what we're doing is we're lowering our interest expense but increasing the value of our asset, and we capitalize interest to these self-constructed assets that we built.